Welcome back, investors, traders, and future degenerate gamblers. This is Beast McFeast here with 10 more investing terms that you probably need to know. I'm not going to go into amazing detail on these. A lot of these terms would require their own video to go into that kind of detail. I'm just going to give you a 30,000 feet view of these things. So let's get started. An exchange. This is the place where your securities are traded. Most likely, if you're watching this, you're in the United States. You're going to go to your broker, not think too much about the exchange you're on. It's probably going to be the New York Stock Exchange, NASDAQ, or American Stock Exchange. Other ones exist. You can go, like if you're in Europe, there's European stock exchanges. And different companies are listed on these different exchanges. The ones you'll have access to, it's going to depend on your broker and what country you are in. Most brokers around the world that I know of are going to give you access to the U.S. ones. But most of this audience here is going to be from the U.S., so it's going to be New York Stock Exchange and NASDAQ. Sometimes you'll go off the exchange with an OTC stock. Oftentimes your penny stocks are OTC, over the counter, where you're trading with from person to person more directly than you do on like the New York Stock Exchange and NASDAQ. These carry potentially greater risk because the exchanges are more closely regulated than off the exchange transactions. To make trades, your brokers are going to charge you a commission, and I referenced this a little bit in previous videos, but your broker, they've got to make a little money somehow, and they can either sort of take pennies out of each trade you make or just charge you up front. I mean, they're going to make their money somehow. These used to be a real problem when the commissions were $100 for an options contract, or like $15 for shares or whatever. But now there's a lot of zero commission traders like Webull and Robinhood, and you can often on more established brokers like TD Ameritrade and Fidelity get zero commission shares trades, but still have some options contract fees. You can shop around and pick whatever broker sort of fits what you want. Just understand that they're going to get their money somehow, and sometimes it might be better just to pay a commission up front than to have your orders not go through at the best price. The clearinghouse. So your broker is sort of like a middleman between you and the market. The clearinghouse is an additional middleman, and some brokers have their own in-house one, like TD Ameritrade and Fidelity and E-Trade. These guys help fill your orders faster and more efficiently because sometimes maybe someone doesn't want to buy exactly what you're trying to sell at the time you're trying to sell it at the price you're trying to sell it at. But if the clearinghouses are organizations that can step in and say, well, I think what you're offering is the correct market price, so yeah, I'll buy that from you, or I'll sell this thing to you at that price, and I'll wait for someone else to come along and take the other side of that bet later, or the other side of that trade later. So they just make things run more efficiently. These companies also ensure that your broker doesn't let you get in over your head in terms of leveraging. So you can't go crazy on margin for highly volatile stocks. The market makers kind of dictate, or the clearinghouse kind of dictates that to your broker. Hedge funds. There's been a lot of talk about hedge funds this year online in the Reddit communities. Essentially, these are wealth management firms that cater to very wealthy clients. You're not going to get in here without tens of millions of dollars, essentially. Traditionally, they would hedge your market bets. So they would pick one side of a bet and say, okay, we're going to be like bullish on, I don't know, internet stuff. But then they'd also take the other side in some way and try to reduce their exposure in case the market goes against them. Now, they do this in more complicated ways, complex investing strategies. It's hard to say if their performance is any better than the average market. There are periods of time where they outperform the market. There are other periods of time where they don't. And sometimes these hedge funds kind of blow up if they leverage themselves too hard. And that's happened a couple times this year in 2021. So an ETF, an exchange traded fund, is a good alternative to a stock. Stock will be in a single company. An ETF is similar. It has its own ticker, like a few letters. Like you might look up an ETF SPY or QQQ or QILD, and they tend to focus on different sectors of the market or a specific subsection of a sector in a market. These are managed portfolios of stocks that a lot of the work in diversifying is done for you. So let's say that you think in the future uranium is going to be the big thing because nuclear power is the way to go. Well, you can go through and find the best uranium miners, hopefully, and like buy 100 shares in the top 10 uranium miners in your opinion. Or you can go and get like URA, or uranium ETF, which has dozens and dozens of uranium miners, in their portfolio. So the work is kind of done for you. The performance of these ETFs can vary widely depending on how exactly they're set up. You can get an ETF that is like one-to-one tracks the S&P 500 essentially. That would be SPY. Or you can get one that tracks like the NASDAQ with QQQ. Or you can get one that tracks the NASDAQ but is 3 times leverage so that every dollar the NASDAQ goes up, or that QQQ goes up in value, this other ETF goes up $3. Conversely, it would go down $3, so you can increase your risk or reward on that. You can also get ETFs that pay you a dividend, and some of these dividends can be quite high, higher than most companies will pay you, higher than any legitimate company I've seen pay out. The ETFs ending in YLD tend to have higher dividends for whatever reason. QYLD has like a 12% dividend, which is insane. There's some trade-offs to these types of things. One trade-off that you make when you get into an ETF is management fees. Now, you're not actually going to get like this bill in the mail, but the value of your holding will passively decrease by 1% a year. So things goes up like 30%, you don't really care. You lose 1% because you probably wouldn't have had access to it prior. I'm going to go more in depth into ETFs and the different kinds out there in the future, and I'll probably look at some specific ones in the future because it seems to be a popular thing to do right now. These things are really great for diversifying your portfolio. So if you want to have access to a lot of market sectors and without a lot of effort, ETFs can get you there. You can get a very diversified portfolio with like 4 ETFs. It's very common. Some ETFs track indexes. Indices are essentially measures of wide swaths of the market. And you can get indices of different market sectors, being like healthcare sector, or consumer discretionary sector, or manufacturing, whatever sectors you want, or whatever like large swaths of the market you can think of, there's a good chance that there's an index for it. And you can get an ETF of an index. That would be SPY and QQQ are the 2 most popular. But there's several others that just sort of mimic the performance of that overall index. So what this gives you is less volatility in that your highs aren't going to be as rapid, your lows hopefully aren't going to be as rapid. I mean, on a bad day, things can go real wrong with ETFs and index funds, and there's not much you can do about it, except for hopefully have a stop loss in place or be short on some of these things. But we'll get into that later. Right now, you just want to know that ETFs and index ETFs give you a wide exposure to the market that would be difficult to achieve otherwise, and oftentimes cost prohibitive. And you buy them just like shares. So it's pretty cool. Mutual funds are similar in that you can get a wide exposure to the market. They're professionally managed pools of securities, but mutual funds are kind of, in my opinion, falling out of favor because they have a minimum investment and they can only be traded at market close, which I don't know. I don't really appreciate. I like an ETF because sometimes you might buy in the morning, see a larger increase than you think should happen, and sell it in the afternoon. Well, you can't really do that with a mutual fund. And I just don't see a huge advantage to these. They're good if you're going to hold for the long term, but I don't know. I don't see it. One thing else you might want to consider holding for the long term are your blue chip stocks. Now, there's no set criteria for what a blue chip stock or a blue chip company is. This just refers to a kind of older, um, persistently well performing company, which generally pays dividends. A lot of the biggest name companies you can think of are going to be these. You select them for stability and resistance to short fluctuations in the market. I mean, if if the like Nasdaq dumps 10%, blue chip stocks aren't going to be too much better off than some of the others. But when the market swings, a couple percent in a direction, blue chip stocks tend to be a little less volatile. So you get some stability out of it. Now, what you trade off, which is similar to the ETF trade for stability, is you get less rapid gains. But you get some consistency and not quite the promise of upward movement, but the history is all good on these companies. It's probably going to continue to be good. And again, past performance doesn't guarantee future performance. Commodities are tangible things you could hold. Like you can go and get a block of gold, 52-pound brick of gold, or a bunch of wheat, or oil. And this is just a class of thing that you can trade indirectly because chances are you don't have a big brick of gold. I mean, you can go order one online. It's super expensive, but hey, you're welcome to do that. When you're trading commodities directly, like through your regular tickers, if you're buying a company that specializes in commodities, you're interested in companies that harvest or mine these things or produce them in some way. And these things perform a little differently than other assets. So in a market downturn, your companies that produce cool stuff, like technology stuff, like your Apples and Amazon, probably are going to suffer pretty hard, but commodities might suffer a little bit less because there is a physical thing backing up the value, and these companies produce that, and they probably aren't going to stop. I mean, farmers are going to be just as in demand during a market downturn as they are in a bull market. So it's nice to have a good variety of things in your portfolio, and you can get commodity ETFs, and you'll see if you look at their like 10-year and 5-year charts, the growth on them isn't spectacular. Now, in times of inflation, it's probably going to be a little bit faster, honestly, and commodities might be a smart bet here in mid 2021 when inflation appears to be quite high. That's still debatable, like what level it's at, but I don't think anyone's going to say it's great right now. Commodity prices are going to go up. Now, this is about investing in companies that make the commodities or get the commodities out of the ground or wherever. Let's say you want to actually trade the commodity. You can do that with futures. These are derivative contracts, typically viewed as a more complex trading strategy, and it's intimidating for a lot of people because of the size of these instruments. Futures contracts can be pretty expensive. So let's say, I don't know, you want to trade oil futures. Well, one oil futures contract is 1,000 barrels of oil. So if you're selling an oil futures contract, you're telling somebody, hey, I'll get you 1,000 barrels of oil and I'll sell it to you at this set price. And what you're hoping is that the value of those barrels that you say you have goes down so that you can just go to the market, like an imaginary oil market essentially, buy these 1,000 barrels and sell it to somebody for a higher price. The buyer of a future is hoping that the price of whatever they get goes up because they locked in a price with the seller. These things essentially work similar to options in that there's a price which somebody agrees to buy at and somebody agrees to sell at. But essentially with futures, you're agreeing to move a tangible asset. Though some futures are financial in nature, so there is no tangible asset. Traditionally, futures have been things you could hold or load up on a truck because remember, we're discussing like 1,000 barrels of oil or some insane amount of corn. It's a ridiculous amount, like hard to wrap your head around how large a future is. One issue that has come up with these is what do you do if you're obligated as the seller of a future contract to provide 1,000 barrels of oil and your contract expires and you got to provide that? Well, what are you going to do? Or on the other side, if you're a buyer, well, is somebody going to deliver you 1,000 barrels of oil? And I've heard that this has happened before, where you're like actually get delivered your 1,000 barrels. But now your broker is going to try to protect you from that because that's not very desirable for anybody. I don't know about you. I don't have anywhere to put 1,000 barrels of oil. Also, I don't have the ability to supply 1,000 barrels of oil. You can buy and sell these contracts prior to expiration so that this never becomes a problem. If I were to trade in futures, I would recommend getting out from under the contract before expiration. It's just good advice. So if you enjoyed this video, found it informative, go ahead and like and subscribe. Go ahead and ask questions in the comments, or if there's any video requests you'd like to make, or you want me to go into more detail on one of these things, go ahead and let me know, and I can do that after I finish this initial video series. Bye.